Welcome to the Atomic Level, the show where we decode the matters of wealth, one insightful conversation at a time, with the rising stars and bestsellers of Substack in both finance, business, and tech, so that you can grow and protect your net worth and, most importantly, your net happiness. As you know, if you are returning to the show, my name's Chris Snook, and today I welcome Matthew C. Klein. We put middle initials in our name when there's a lot of us out there on the interwebs, and so I think we go by Matt or Matthew, but I'm going to find out. Welcome to the show, my friend.
Thank you very much, Chris.
So is it Matt or is it Matthew? Do you have a preference?
Yeah, Matt is usually what I go for. And as you said, I discovered early on, in fact, my same year in college, there was another person named Matt Klein. And so we got a lot of each other's emails and stuff. So I had to, especially in journalism, putting your name out there, it's helpful to have a middle initial to be somewhat distinctive.
Yeah, no, it does. And we're going to get into kind of that background and what you're doing today as well. And it's funny because I have the J in there. And it's so weird when you're talking about yourself and you don't want to sound like an idiot in the third person, like Chris J. Snook. Like I do it. But the reason why is because I grew up on the East Coast and everyone talks fast. And so people would just forget that there was an S in my last name because they would say Chris Snook, but it would sound like Chris Nook. And so when I started getting interviewed and stuff, like people would publish like a podcast with my name, capital N. I'm like, no, that's not right. So I understand the middle initial thing. It's not for anything other than practicality. So let's dive into kind of what you're doing today. But we always, as those who are new to the show, we always start with kind of a loose narrative arc, fully unscripted. I get to know you and your work on screen in front of my audience and yours, and look to pull out things that other people haven't discovered yet. You've been doing this on Substack, I think, for over 5 years. We'll talk about that journey, but we start with kind of the man and what shaped his worldview. So give us a little background before we get into kind of what you're writing about, what your work's about, and all that.
Sure. So I got into econ and finance. I wouldn't say quite by accident, but it's sort of something I fell into. In college, I didn't really know what it was I wanted to do professionally. I was interested in things like ancient history, and that's not, there are jobs for that, but they're very few. I was fortunate that I got an internship at a macro hedge fund in the summer of 2008, of all times, and that they had the enlightened view that whatever I knew or didn't know going in was incrementally useless to them. They just wanted someone they could teach, which is why I was able to get that internship. And then that was a very interesting experience. I realized the global economy is just a fascinating, the linkages between the economy and the financial system and how it affects everyone, whether or not you personally understand it. I just found it really fascinating to think about these situations. And then you have the financial crisis, and then it kind of really brought home that this isn't just an interesting puzzle or a way that you can make money, but that if things go wrong, it can hurt a lot of people. And conversely, if you are better informed, or if policymakers are better informed, then you can have things work out much better. And the basically the consequences of getting it right or wrong are very significant, and that is really worth trying to figure out and understand and communicate, so that more people can understand and hopefully do things that make all of us better off. And so then I wanted to make the transition into journal, into something where I could really do that, kind of that explaining role. There was a columnist or still a columnist at the FT, named Martin Wolf, who I
Hmm.
encountered during this time, or I encountered his work. I mean, I read it. I thought, this is great. Like, I want to do this. This is my, lodestar. And then, of course, the question is, well, how do you get there? You can look at his own career path, and it was pretty unusual relative to a lot of people who write for a living. So that didn't seem like, in and of itself, particularly instructive. But I thought, well, going into financial journalism maybe would be a way to do that. And it was tricky to make the transition, but eventually, so I ended up first. Working as a research assistant for Sebastian Mallaby. He wrote a really great biography of Alan Greenspan. I worked with him for a couple of years on that. One of the things I did was I read every single FOMC transcript from when Greenspan was chairman, which is like, I think, 18 years worth of
Wow.
material. Yeah, I mean that took basically like 11 months of the two
You must
years
have
that I
slept
was with him.
well. You must have slept well on those nights.
Yeah, well, it was interesting because, like, all right, on the one hand, it's like, wow, that sounds really boring. On the other hand, it's I never it's nothing that I think anyone would otherwise have done if they weren't just like their full time job during the day to do it. But it was really interesting to get that base of knowledge, and I mean, it's still useful for what I do as a perspective. Like, okay, this is how people thought about all these issues over this not super long stretch of time, but a long enough stretch of time. You can see a lot of different things happening. It's certainly relevant, what I've been doing more recently. And then from there, I was able to eventually get some real journalism jobs at places. I was at the FT for a bit, um, and then I was at Barron's for a few years, and then, yeah, as you said, about 5 years ago, I left Barron's to start the Overshoot, um, which I've been doing since I guess it was July of 2021. Oh, and
Was
I
there
should
a,
also
go ahead, go ahead.
sorry, I should also mention, don't want to leave this out, but Michael Pettis and I co-wrote a book called Trade Wars or Class Wars, which came out in 2020, which is also a you know um, that really came out of a lot of the work that you know he'd been doing for obviously a very long time, and I'd had a chance to meet him and work with him, edit some of his pieces at Alphaville, and we worked together, and that was a fruitful collaboration.
It's awesome. So couple things in there as just a summary and round that out. The ancient history, kind of passion or hobby that kind of led you into, well, how do I make money, being in ancient history? It's kind of interesting. Like as I think about your career path into journalism through hedge funds and financial journalism, it's almost like you recognize you kind of came out, whether you were conscious of it or not at the time, I don't know. You came out at a period where we had the great financial crisis. Like we had a moment in history that was being documented and worth documenting, still unfolding, villains, victims, and heroes. Like you couldn't ask for a better, story, right? To kind of be sitting in the middle of. I wonder how much of that interest in ancient history led you down the path of wanting to write, or were you kind of always a writer? Like, in other words, did you write as a kid, or was it more like, huh, something's happening here. I kind of want to write about it from my lens. I want to do the work. I want to understand this for myself, but also tied to the fact that like you recognize history's been documented by people, and so why not document? Was there any of that, or was
Yeah,
it kind of just
I don't know if I came at it as the perspective of I want to be an historian of this period per se. Although, I mean, I think what history is really good for, as just as a discipline is, and I think it's actually very related to what people do in finance and a lot of other fields, is that you have a bunch of sources of various level of either trustworthiness or comprehensiveness or whatever, and you have to somehow synthesize all this material and come up with a coherent explanation of what actually is happening or happened and why. And one of the interesting things about it is you can see that there are many different ways of taking the same inputs and interpreting them in all sorts of different outputs. I mean, ancient history is sort of an extreme case because there are just so few sources available. Um,
Mhm.
I mean, I remember being told that something like the joke was that like the thing about ancient history is you could literally be read every single possible source that currently exists from a couple thousand years ago, and you still won't know mostly what happened, and you have to use a lot of imagination to kind of guess. And then you have all these people who have done the same, read the same exact material, and using their imagination in different ways to come up with all sorts of different interpretations. And that's interesting. I mean, in many ways, I think there actually is very much a relationship between that and global macro. I mean, on the one hand, there's much more data, right? You
Mhm.
cannot ingest everything. But at the same time, as you can see, anytime people debate something simple like, well, how do you interpret this latest inflation report or what have you? It's the same issue of, you know, there's a set of information out there. There are many different ways of recombining it, interpreting it, and synthesizing it. And the question is, how is that, like, what makes the most sense? How do you identify causality? What's noise, and I think those are actually very related disciplines in a lot of ways.
I think I agree with you. I as I listen to you, I think, both of them are human beings extrapolating what behaviors they thought other human beings would
Mhm.
do given those set facts and circumstances, and we're guessing, right? But
Right.
what we're not guessing at is we're not like there's enough data sources, some like you said in ancient history, there's thinner sources than there would be for global macro today. But again, there's also less noise. There might be more signal. Like you could argue all those things, but at the end of the day, both people are just trying to go, what is a human being doing?
Mhm.
Like what, and then what is their ability to move a lever, right? Like, so I think it's interesting when you read all the FOMC stuff, you kind of went to, okay, there's what gets said on camera. There what's get reported on the news from whatever lens that news media organization is bent. And then there was what was in the 200-page document and footnotes.
Right.
And and sometimes those things reconcile, and sometimes they're nowhere near each other, and so you're trying to figure out what's gonna happen, and if you don't go into the footnotes, you don't really get the full story.
Mhm. I mean, one of the fun things about the transcripts you mentioned about, being on camera or not, there was a transition, I think it was around 1993 or 1994, when, everyone at the Fed didn't know that the transcripts were actually being made. they didn't know they were being recorded and the transcript being written
Mm,
down. And then they do discover it. And not only do they discover it, but they discover that because once Congress discovers it, they say the transcripts have to be published. And so you can see very clearly this like transition from how
man,
they
I would love
talk
to see
to like,
somebody run
yeah,
that through Claude or OpenAI, right? Like, take
yeah,
all
it's
the transcripts that were there, that are
yeah.
public that they didn't know were being recorded, and then take the ones and see how much they changed, right?
I
Like,
mean, you don't need a it's not a very you don't need a very sophisticated algorithm to see, like, it's very clear, like, suddenly everything becomes much more polished and buttoned up, right? They're not gonna make sort of off-color jokes about whatever's going on in the world, is one thing that changes for the most part.
right,
They still do sometimes, but much less frequently. The other thing is that when every time it's someone's turn to speak, it's much more like you can tell they wrote it in advance, because that's and everything they say. So, that's, like, in and of itself yeah, so if you're getting a sense of, like, what do people really think, I mean, you can see the, like, the more unfiltered version versus the more filtered version. So even then, there's, like, the transition of what, you never know exactly what's going on in somebody's head. You just know what someone has written down, which is also, again, true in the historical record of, like, okay, you might have someone's diary or archives, but they still could have in theory, that might not how believable that is. And the question of the unreliable narrator is true in any field.
right.
It's true with data too, right? Like, how much do you believe that the data are necessarily representing what's going on, either because there might be measurement issues or, potential for revisions or methodological, changes that might transport all sorts of things, right? So that's like the judgment of the analyst of whatever discipline it is to figure out how to filter all that out.
So you had some formal training, in economics, and then you went and worked inside of a hedge fund and were trained there, kind of like as a fresh open
Well,
mind with
the
some
formal training was
addition.
basically there, actually. I didn't really have a lot in school, to be honest. It was mostly there.
Okay. Okay. So you got formally trained in economics kind of on the field of battle inside of a hedge fund in the heart of the financial crisis. And then you moved over into journalism. And was that also more of an apprenticeship type schooling?
Yeah, I mean, again, I'd done writing. So there one thing that's worth noting is just journalism itself is a very there are lots of different kinds of things, right? There are people who are war correspondents, there are people who get scoops and there are people who do, like, deep investigative journalism. There's people who do, you know I don't do any of those things. There's, like, a whole bunch of different kinds of things you can do and that are important and valuable and different skills. Um I do, I guess what people now would, the sort of econ finance, like, data journalism thing that hadn't really been existing quite the same extent. I mean, it's become much more of a mainstream thing now. It was sort of nascent when I started doing it. So, in a certain sense, yes, I mean, I did not have much of a background in that. But then again, not a lot of people did. My first journalism, so when I got into it, it was an internship at The Economist. They have this wonderful program where they take people and again, kind of their thing is, we don't necessarily care if you've had formal journalism training per se. We just care
Mhm.
if you know enough about the material and we think you can write. So, you have to send in a submission of, like, a piece that that they think they could run in The Economist, and then some ideas for other pieces. And then they interview and all this stuff. And somehow I managed to get this, which is great. And then, once I was there, then it's like, okay, well, now you have to, like, produce articles and stuff, and you go and, like, they're very rigorous in their editing. The
Yeah.
reason why The Economist magazine, it sounds like every article is written by the same person. It's not that they are written by the same person, but it's because they have layers of editing and a very defined voice, and it's really useful, especially if you've not had a background in writing articles like this, because you learn quickly, like, okay, how can I write in the style? Like, can I see how I can get edited as little as possible? And then you're like, okay, that gives you a very good flavor for learning that. And then from there, um, but ultimately, it's like any discipline, right? The more you do it, the more practice you have, the better you get. So,
Right.
my wife will say that the early articles I did were not very good, but, you know, it's been long enough now, things get better, but
Well,
yeah.
yeah, I mean, that probably goes without saying, and the wife is always the best critic because the one that keeps us grounded when everybody else thinks our stuff is great. It's like, okay, well, I still got some work to do, maybe.
Yeah.
So, all right, so let's shift gears into kind of your operating system. Like, you're focused on, for lack of a better word, data driven journalism, financial data driven journalism. That's kind of your sweet spot niche. It sounds like. Expand or correct that however you'd like. What was the catalyst for the overshoot starting? Was it because you were limited in some of the things you wanted to write about where you were prior to that, at Barron's or wherever? Was it just kind of the book came out and you kind of got a taste for that being your own thought leader, and so you're like, now that the book's out, maybe I'll add to that with the ongoing. Like, what was the catalyst and decision tree, and then what are you able to do at the Overshoot that you weren't able to do before?
Yeah, that's all great questions. So, I mean, first of all, Barron's was great. I know some people leave where they were to go to Substack because they feel like they hate their editors or whatever. Like, that was not my situation at all. I mean, really, it was this. I mean, it was a very busy, active time with the pandemic and all the things that were going on in the world, and like it was, as with many fields, it was like a heck of a time to be a financial journalist. All like every day something going on, and that wasn't the issue. And it's interesting. They were very supportive of me doing all sorts of writing about all sorts of things. It really was, you know, at the end, like if you remember this period of time, like 2020, 2021, among the people who left established journalism jobs to go independent, at least some of them ended up doing very, very well, financially. And, I looked at this, as I'm sure a lot of people did at this time. I thought, well, I'm not necessarily going to make that level of success, but the gap between what I was doing and what they were doing was so large. I thought, really
Right.
any intermediate point it would be worth a shot, right?
Yeah.
Um, and so, that was sort of the motivation. And at the time, I talked with some, close friends of mine in the field who I trust, and they're like, look, try it for a year, see what happens. If it doesn't work out, like you can probably find another job, like a mainstream publication. Um, so I anyhow, and luckily it did work out. So that wasn't
And
the
you
issue.
were already working remotely, correct? So you're
Yeah,
in the area
that's right.
and you were able to kind of already do what you were doing from where you are right now. So it wasn't like a motivator, I don't want to be in the office in New York anymore.
Yeah.
It was a little bit more just opportunistic, it sounds like.
Yeah, I mean, for better or worse, like I was at the vanguard of remote work before the pandemic because I moved out to San Francisco basically shortly before I joined Barron's, and they're in New York, and there was no one else really there at the time. So I just was working from home. I wrote the book from home. So I mean, I do sometimes miss the camaraderie of being in an office. I mean, when I was at the FT, that was a nice thing, but on the other hand, like I mean, not having to commute is also nice, and I like where I live.
Right.
So, there's a whole bunch of things, but no, that was not a motivator one way or the other. I mean, the other thing is that so before I was at Barron's, part of the reason I moved there, which I thought was interesting, it was more of a structured magazine situation of like you're going to write. There are other things I could do, but part of the deal is like I have a weekly column. It's 750 to 800 words. Get a couple charts, and it was like okay, if I wanted to, thinking back to that sort of lodestar goal of being Martin Wolf, it's like well, this is kind of that, right? And it's I mean,
Mhm.
this style. I mean, obviously, it's like not the same, right? But it's like okay, you write like the weekly kind of like this is Matt Klein descends and gives his view on the economy or whatever. And so that was fun. That was like a great. And like there are other things I did in addition to that as well. But that was my before I did that when I was at the Financial Times, I was writing for Alphaville, which is a blog they have, which is much more open ended. Um, you can kind of write about whatever you want, whatever length you want, as no matter how technical or accessible. I mean, you want to be clear and do a good job here, but it wasn't. If you wanted to do something very kind of obscure and say like Iceland's balance of payments, like they think that's great. Um, and so whereas with Barron's, understandably, like maybe I could do that, right? But then I'd have to like make a pitch for why it would be compelling. And I mean, as I said, like they were actually very cool about letting me write about all sorts of things for a column that like the typical Barron's reader would not necessarily want to know like what's going on with Turkish capital flight in say 2019 or 2018, whatever, which I wrote about like that, and they liked it. So like it was fine. But to sent that like I'm now independent and not having someone saying like this is a structure of what you should be writing about or whatever. Like I'm fortunate that I had that preparation of sort of that blogging background before, because that's in many ways kind of like what I've come back to. Not that I have any. I mean, I still enjoy writing sort of formal column things, for other publications. But I mean that sort of in many ways sort of
Well,
the
and you kind
Alphaville
of
style.
unlocked I don't know yeah, I don't know when you kind of unlocked which part of this. I'm sure there was multiple iterations because you were early. So Substack had, like, a moment in late 2019 to, like, through, like, when you got started where it was kind of, "Oh, hey, I think I'm gonna go over there," and I stood up this newsletter, Wealth Matters 3.0. I stood this up somewhere in late 2019, if I remember
Mhm.
right, and because I was, like, in between stuff. I was like, "You know what? I miss kinda writing. I'm gonna kind of refocus that, and I wanna do it somewhere where there's already network effects, right?" So I
Mhm.
kind of got attracted over. I shut it down for, like, 3 years because after about 6 months of that, I kinda got busy with a funded startup that I was doing, and I was like, "Okay, well," so I had this, like, pet project of, like, "Oh, I'm gonna do this Substack thing." But during that time, there was some financial people like yourself that were kind of really, I guess, early but on time to that first wave of success with Substack. And so you kind of joined and started your newsletter at a time where there was like that run up. I think then it went dormant for a while, and then about a year ago, it kind of became a thing again, right? Substack's kind of had this moment. And a lot of people in finance are now moving over here. Intent based search kind of became more of a need because people, I think, were tired of the noise in the feeds of everywhere else. Long form writing was kind of missed and cherished. And so you've benefited from that. I'm curious from your 5-year perspective, before we go back more into kind of some of the framework stuff, just you sell to institutional subscribers. You're one of the few guys that I see that's doing that, like in your 3 tiers, right? You also have, ways to talk to the everyman investor or everywoman investor. And I don't know if that's how you started it. I'm just curious, like, was that the market that you served when you started the overshoot, or were you kind of evolving into that as you started to figure out your voice on Substack and what it all was? And just, I guess, curious about that journey and evolution.
Yeah, no, it's a very reasonable. I mean, ultimately, there's like the things that I find interesting and can write about, and then I figure if I can write about it clearly, everyone's going to appreciate. Like, no matter how technical you are, like the clearer the writing, the better. So I do think there is sort of a hurdle. Like, I don't want to be unnecessary, like unreasonably difficult to read, but like I'm also not aiming to be the sort of lowest common denominator, if that makes sense. I mean, the sort
Yeah.
of pricing sort of reflects that. But I noticed from like early on, just from my other job, like when I was at the FT, when I was at Barron's, like there are plenty of people who read my stuff who were, professionals, whether they were in academia or in asset management or in like policymaking, central banking roles. And so I figured if those people were already reading me, like they could read me now, and if there were a way to sort of structure that, so I mean, in a certain sense, it's like I write what I write, and then I see and then for certain kinds of things will appeal to different kinds of people, right? So
Right.
I did a lot of stuff. I have done and continue to write about like the Russia Ukraine war. I did a lot more of it when at the beginning, but I've continued to do that, and like obviously that appealed to a certain set of people in governments in the U.S. and elsewhere more so than it might have appealed to certain kind of asset managers, although they might find it interesting, but like it's not necessarily kind of like core to them. And other things I write about are interesting to other people, right? So it's a sort of, at the end of the day, there's certain things I see like, oh, these are popular topics, right? And like I sort of will necessarily kind of come back to them. But it's I think the easiest thing in some ways is just to be guided by what do I find interesting, and then make the sort of leap of faith that if they've stuck with me this long, like they will continue to, or at least enough of them will. And that's roughly like, because there are these different groups, but there's enough overlap in what they might find interesting. There's like what's core to their business need versus, the kind of thing they'd find interesting if it's not their core business. And so that's okay too. And like they'll still want to read it.
Yeah. Well, I mean, you have 53,000 some odd subscribers. So what you're doing is working, because that's on Substack. That's a significant number, both free and paid. And again, that's not the point. But the point is, I think all of us are looking for people that are thinking about things or interested in things that there's a void in discernment around or distillation around, right? So I think part of the value of what I do when I try and meet guys like you is for my own brain, who's out there curiously poking, you know, at stuff, who can articulate that with a nice narrative, easy to read, but with data. Like, in other words, it's not just some made up thing to get a click. And I think that's what I see consistently working, regardless of what the topic in finance or business or tech is about. It's kind of the approach is one where on Substack, the people that have gotten success or kind of the power law of subscribers like you, I see them being kind of innately personally curious and just attracting a community of common interest that doesn't have the platform yet, right? In other
Mhm.
words, like you open up this room and say, here's what I'm curious about, here's what I'm poking on, here's what I'm thinking about, here's the data I'm seeing. And then you're allowing people to kind of participate in that might be looking for that void, even if they can't put their finger on it. And I don't think that changes. I think that kind of continues. I think we need to be more curious, especially in a world where most of us have forgotten how to think, even if we think we still do.
Yeah, no, for sure. I think people are always. I think there's always going to be a market for things that people find interesting. I mean, sort of by definition, right? And so the question is, how is it can that we can be interesting and add value by actually understanding what's going on? And it's a very complicated, complex world. So, I'm not going to say that I know everything, or I mean, but like, there are a few things I think I can add. I can make it helpful that people may not know, and if I can find those points of value and explain them clearly, then that's a market. And a lot of people, there are lots of ways of doing it. Lots of people do them in different ways, and I think that's great. And whether they whatever platform they can find to do that. I mean, there are people, sell side research. There's sell side research that's good. I mean, that's sort of where I think of myself sort of the nexus of sell side research and journalism, which in some ways, I mean, those are always very similar. It's like, where do you draw the line? Is sort of the price point, right? But that's I think that there's always going to be a market for people to learn things about the world, have complicated things explained that they so that they can make better decisions and just know what's happening.
Do you see yourself more as kind of, like the sense maker of all that complexity, of the global nuances, of the geopolitical, the finance? Like, do you see yourself as a sense maker? Do you see yourself as a truth seeker? One, heavier, or are they equally weighted?
I'm not sure I understand exactly what the difference might be, to be honest. I mean, like, I'm not going to break new ground in the sense that as I said, we're talking about different kinds of journalism, right? Like, there are people who can get certain kinds of people to tell them things they wouldn't otherwise tell other people. Um, that's incredibly valuable. That's not what I'm going to be doing. There are people who like will go somewhere really remote and see something. And again, like, that's just, I mean, like, as that's tremendously valuable. That's great that they do
Right.
that. That is not what I can do. What I can do is I can look at like data that's published and like, is that weird? Or, why is this happening? Or how do these pieces fit together? Or did someone something else say not make sense? Right? Like, there are lots of so there's lots of space for different kinds of way, and so that's sort of how I see. It's either it's just asking a question of something, or just saying like, how do these pieces fit together, or what do these numbers actually mean or not mean? Knowing how the sausage is made, I think, is very valuable, and something that obviously a lot of people are not going to invest the time into it, because you don't necessarily need to most of the time, but it can be useful for certain circumstances, and so that's kind of where I try to kind of pick my spots.
I always like to understand, and I usually disclose my own biases, because I say, like, I've formed them over decades, and so I'm happy with my biases, but I also recognize that I have them. You should know what they are so that you don't take what I say as anything worth at face value without knowing that, right? So I always love to ask someone like you, what, especially with a bend on kind of history as like a baseline passion or follow through point. What are the books that shaped your current way of thinking or analyzing things that you haven't disproven yet? In other words, like, for me, there's Fourth Turning or Watchman's Rattle, Creature from Jekyll Island, Connectography. There's 4 or 5 books, Think and Grow Rich, right? Like, there's 4 or 5 books that I would say, you know what, these books, like Psycho-Cybernetics, that they kind of really shaped how Chris thinks humans work, the world works, money works. I'm constantly trying to disprove them. I'm trying to learn, but that's my bias.
Yeah.
What are some of those that shape yours?
So a couple things. One, I mean, I mentioned I co-wrote a book with Michael Pettis. Before I co-wrote a book with Michael Pettis, which if you told me, 15 years ago that I would have done that, I would look at you like crazy. I mean, like, I learned a lot from Michael Pettis. So,
Mhm.
Volatility Machine is fantastic. Great Rebalancing is fantastic. I mean, those really shaped a lot of my understanding, and my framework of looking at how a lot of these pieces fit together. I don't think it's like really in a book per se, but like Ray Dalio's thinking
Mhm.
about the global economy, like the machine.
Right.
Um,
Economic
like,
Machine, the 30-minute video, and
yeah, I mean, there's a lot more than that, right? But like,
sure.
that's what I was steeped in, right? When I first learned all this stuff, and so that's been very influential. Like, thinking about like, like debt processes. I think he has I can't remember the name of the book, but he talks about like the way that, I mean, it's online actually. You can like,
Yeah.
it's like a PDF about deleveragings and debt processes and debt crises, I think is what it's called. Like that kind of framework also very um influential in my thinking. Um, I mean, those are some of the. I mean, honestly, like, those are probably the two biggest for like thinking about economics and finance directly. Um, but like there's other books about other things that are interesting, I guess. But like that's like kind of really
Yeah,
where
that's
they
what I was
stick
looking
out.
at. It's just
But
like, kind of, what are some of the things where you go, "Yeah, I kinda see the world through this perspective because I it made sense to me," and so
yeah,
again, I think, a lot of people are fans of that work or who have referenced that work, even if they're not, 100% in agreement with it because it's well done. I mean, Dahlia did a great job, especially that, when you think about taking the complexity of the business cycle, the productivity and the debt cycle, and
Mhm.
then teaching that to someone that could be in fifth grade in 30 minutes or less, like
Right,
the genius in that is the editing and then the
right.
simplicity of communicating the end point. Um, so I think that's a great contribution in general, just for people to have as a framework.
Yeah,
So what's got you most so let's talk about kind of what you're applying your framework to now, what you're most curious about, what's like the unanswered questions? Like what are you diving into deeply that's been published or that's kind of on the horizon of things? And let's try and unpack some of the questions you have about where we are in the
sure.
macro.
Well, the easiest thing I can say is what I've literally been working on, as of right now, which is this big question about, productivity and the relationship between AI and productivity. And then sort of this third point, which is also related, I think, and part of it is like, what is the implication for interest rates if
Yep.
you buy the story? And so I just published something earlier this week, or I'm not sure which week it's called, but yeah, in early August, about this question, and I realized as I was working out that I couldn't fit it in one piece anyway, so I'm split it up. But I mean, the first point, just like, is productivity actually accelerating in the data? Like there's sort of the question of, is productivity accelerating in some sort of deeper sense versus like, what about, it was just showing up in the actual data that we had that's official in productivity. And what's striking is the answer is mostly it is not showing up in the official data, right? Like maybe it will. It doesn't mean that these aren't incredibly productivity enhancing technologies, but as of now, it's not. And what's interesting is kind of looking at how this, again, how is the sausage made? I mean, productivity is notoriously tricky because you basically, at a minimum, you need 3 different sources of data and just divide them by each other, right? There's nominal spending, total of dollars that are either spent or earned in the economy is equivalent, but right, that. There's, prices, so you have to have a good sense of measuring inflation across a whole bunch of different things, and, how many hours are actually worked, because productivity is normally defined as, how much you produce in a given hour of work. And you take those 3 things, and that's how you get the standard productivity measure. So all of those things are prone to error and revision and all sorts of things. So it's already kind of tricky. And if you look at it quarter to quarter, it's a very noisy series. It's basically
Okay.
gibberish, an unreadable chart. But um, and there are issues historically where, like, during recessions recently, in particular, the past couple of downturns, like, the people who are more likely to get laid off are the ones who are paid less. And so what happens mechanically is that productivity appears to go up a lot. And then as those people are rehired and the economy recovers, productivity goes down. It looks like it, right? Like, it's not literally what happened. Like, that doesn't make sense. But that's sort of like the other issues. And so looking at some of the, and there are adjustments. So the San Francisco Fed actually has some really interesting work about trying to adjust these things, trying to get a sense of what is underlying productivity. You strip out these different things, just get a sense of what's technological progress doing. And their measure actually is even more striking because not only is productivity on their measure not accelerating, it's actually slowed down a lot, in the past couple of years. And I was looking at this and, like, it seems kind of weird, and it's possible that there might be an issue with the way their measure is constructed. I don't know, but it was interesting. That's like kind of what I did before. And then the next question is, well, let's just say that productivity is accelerating or going or poised to accelerate for a while, right? I mean, like, one thing interesting, if you look at the past, and like the last time we had a big productivity acceleration due to a technological innovation was from, like, basically between the end of 1996 to, like, the end of 2003. That like period, we had this big, and obvious why that was, right? But and that's the official data, right? But all the technology that's associated with those productivity gains actually was developed way earlier. And in fact, if you look at market pricing of things like what were the most valuable companies in the United States, you could already see years before that that people thought this was a big deal.
Mhm.
And yet didn't show up in the official data for years. So, like, it's entirely possible that we are in, like, the 1995 period now where the official productivity data are still kind of meh. But then in a couple of years, you see this big acceleration. That's entirely possible, right? So, like, I'm not saying, like, just because it hasn't shown up in the official
I
data
wanna I
that
wanna
this is
throw
nothing
some
good,
I
but
wanna throw some personal observations at you and see
sure.
what you make of them because this is super interesting to me. I had Danny Diane on,
Mhm.
Tuesday talking about interest rates too, so I'll reference back to that, but I this is actually really, where the heart of my kind of personal activity has been as I think about the portfolio, advising clients, things like that. So I love the macro stuff, but I'm also just inherently, like, roll up my sleeves micro guy. So
Sure.
oh, I want to take your word for it. I want to take other people's word for it. And then I go, but no, dude, like I see human beings over here and they're not doing that, right? They're not doing what that says. So here's my real world example. I'm not going to debate the productivity numbers aren't showing because MIT's done research. Like there's been a lot of that on looking at the spend and going, it's just not there,
Mhm,
right? Whatever this gain is. Um, but then then I have like this little nothing burger club that I started locally in slow, when OpenClaw dropped. And I just recruited small business owners, that want to learn about AI and said, hey, we're going to build on Thursday nights. And it was more of an experiment, to see if anybody wanted to build that community, but more just see who showed up. And uh, there was all people that never knew anything other than how to send an email show up, like whatever. But one of the guys that showed up was this 2-person car dealership. I've talked about them before in other episodes. Those guys are definitely seeing productivity. We're talking about a used car dealer with 3 full-time equivalents, 2 of which are the owners, 1 mechanic that operates in a very low rent, well-positioned dealer like footprint. They rent the
mhm,
place. It's like $900. Their overhead is very low. And they have now, with AI in the last 6 months, built an AI agentic sales force, marketing force, listing agent,
mhm,
custom website for, fractions of $10,000 maybe, right? And they're on pace to do probably 3.5, $4 million in revenue selling sub $25,000 quality vehicles this year. And that'll be their first full calendar year in business. So to me, I'm going, here's a 3-person outfit selling a tangible real world item that no one knows is using AI, but that is going from $700,000 in revenue in their first 8 months to probably 3.5 million this year with the same headcount.
mhm.
So I can't say that's productivity growth. What I can say is if that extrapolates out at any level, then we will see some pretty interesting things productivity wise,
Yeah, for
right?
sure.
Because of AI. But we're not going to see it in the data that we're getting because the data we're getting has a lot of employees and a lot of people and whatever. The other thing I would say is I wrote a piece about this, the white collar cliff, because what you said about low age runners, like you see that data immediately. Now, I agree with you. The correlation may be wrong. But if somebody gets laid off that's check to check, then, the next Friday they don't have that check. Their spending goes down, their consumption goes down. Like you can see that, right, in
Mhm,
the data relatively
right.
short term. But now we're talking about white collar jobs that may or may not be replaced with something new or that there's been like this layoff. Those people typically have pensions, they have retirements, they have golden parachutes, they have like severance.
Yeah, it depends how old they
Not
are, but yeah.
always, not always,
Yeah,
but theoretically, it doesn't happen Friday,
yeah,
meaning it might take 6 months because they think, "Oh, I'll go get a new job." So they get hustling and they start putting
mhm,
their resume out, but they lie to themselves for 6 months, meaning the spending doesn't stop. It doesn't go down right away because they think, "Oh, I'm gonna get another job," or, whatever it is. They have enough where they can continue the lifestyle, and they're just like, "As
yeah,
long as this doesn't last too long, I'll drop down a little bit, but I'll make it back." But we might be in a situation, I'm saying we might because I have no idea. We might be in a situation where in 2027, that denial stops happening. And the fractional reserve thing that everyone went out and said, I'll hang a shingle and be your CFO now that I got fired, but I'll do it on a fractional basis. When every one of you is doing that,
right.
20,000 wide, there's not enough small business clients to need a fractional CFO, right? And so now all of a sudden you start to see the pinching happen. And I think that's where this productivity thing is kind of like it's a good metric, but I don't know that it's so clear
Yeah, well,
that
I
it's
mean,
not gonna make a difference that it
I
will.
guess there are a couple things. One is what happened with the car dealership example, that should show up in the data as productivity because basically they've generated way more sales with the same number of people. So, like, that should. I mean, the question is, I mean, there are a couple things, right? Like, they've done this, but I'm guessing economy-wide, clearly, not everyone has managed to have that kind of success implementing this yet. There's, like, a long
Without
diffusion.
question, right? It's still early. We're still
Right,
very early.
and, like, so that's I mean, it's just a challenge in sort of the
And
measurement.
no surprise here, but the other side of it is that economy-wide could be a leading indicator is their mid-20s, late 20s. So if you think about it, right, and you think, well, what is a 27-year-old person doing today, regardless of what industry they're in? They're doing this. They're joining call they're learning this stuff. They're on X.
Mhm,
Their whole feed is about the next model and what to do with Kimmy K3, even if they're not telling anybody. Doesn't mean it's going to translate into productivity tomorrow, but it does mean that as soon as a couple people see a use case amongst peer set, like a 27-year-old
mhm.
old starting a car dealership but using AI to build the back office, all of a sudden you get a bunch more 27-year-olds starting car dealerships.
Right.
right? Like, so I'm just saying, like, there's this kind of qual.
Yeah, and I think that should show up in growth. I mean, part of it is, like, as a measurement issue. I mean, even, to get back to, like, having read all the FMC transcripts, like, Alan Greenspan did not make his argument about productivity being a big deal until 1996, right? Which
Mm,
was still just before it showed up in the official data, but it was already after a lot of people kind of naively considered, well, like, the internet was a big deal, computers are a big deal, Microsoft was already one of the most valuable companies in the world before all that, right? And he still wasn't making this argument until later, right? So, there are these
What
lags.
was the catalyst then? I wasn't aware of that. So what was the catalyst for why he started making the argument?
Well, I think it was more obvious then, right? But, like, I guess it's just that, it hadn't. I mean, so the general point, the question they had was at that point in time, which is a question that I don't think is relevant now, but some people want to make it relevant now. It's like, well, we were having a situation where growth was very robust, unemployment was falling, and inflation was being unusually tame. And that was a situation that people at the Fed were just not familiar with for a long time because you didn't have that sort of confluence of factors. And so they were trying to come up with examples. And so actually one of the earlier examples that people had come up with, including Greenspan, was like, well, like in like 94 or 90, like 93, was like, oh, well, people are worried about uh job losses from, globalization and things like NAFTA. And so because there's like, even though people are employed, there's more of a sense that they might get laid off. And so they're not asking for wage rises, and that's keeping inflation down. That was a view. Then there was an argument of like, oh, well, HMOs are doing all this stuff to keep down healthcare costs, and that's a thing. And so like people came up with these various idiosyncratic explanations. And then only later was Greenspan saying, it's the computer, it's productivity, it's the internet. And even then, some people were like, well, maybe, but like it's not showing up yet in certain sets of data. And then like it later did. And there's a and but that's sort of like the chronology, but like the phenomenon that they were trying to explain was already showing up in the sense of you had unemployment continuing to fall, growth continuing to be strong, and inflation being in fact, inflation was getting slower in that period. It wasn't just stable, it was getting slower. So that's how that started, which is different from now, but that's, like, the argument
Yeah.
then.
And contextually, so keep going on that, but contextually, like, it makes me think too. The other side, back to interest rates, right? Interest rates were healthy then. I mean, I remember
Yeah.
in 2000, I think it was 2000, buying my first house, and I had a paper like I had 740 FICO or whatever, and my interest rate was 7 point something percent with a paper, right, in 2000, and that house was $206,000, 3 bedroom, 2 bath in Oceanside, California. And, nothing big, a starter home, right? But it was 206,000 bucks. So my mortgage was like in the high hundreds or whatever it was right after my down payment. And my payment was like 1700 a month still, like, cause the interest rate was 7%. And that's what a paper got. I don't even know if I could have gotten a loan with 650 back then. I don't know. Maybe I could have. My point is that we hadn't financialized the entire productivity story yet. So it's kind of interesting contextually, like in 96, if Greenspan is the one who says, hey, this productivity thing kind of matters, computers changing that, da da da. The multiples back then were also a lot different. The
Mhm.
markets were a lot different. The interest rates were kind of right where they needed to be minimum. We hadn't had the dot com crash yet. And so we didn't kind of start to financialize that engine like we have for the last 30 years. And so now the question becomes, where do interest rates go? I think I got convinced this last 4 days that we're going higher and we have to. And I don't know that I was there until 3 days ago.
Well, I don't know higher than we have to, but I think the question is, like, I think you're asking exactly the right question, like, what are the interest rates that make sense? And I think that there's been a view, pushed by, or at least I think Warsh had made this view. I don't know if he's said it as recently, but, like, if you have a productivity gains from AI and that pushes inflation to be slower than it's been, then you have room for interest rates to fall from where they are. And what I think the experience of the last productivity acceleration that we've had shows is that actually interest rates could be higher than they are now. And I mean,
Mhm.
that's your point. Like, I mean, this is something I said a little bit in my most recent piece. I want to get into more in the follow up here, but like, if you think the economy is going to grow so much more, then the cost of capital should be higher because the potential returns on investment and taking risk are going to be higher. And so the returns from just lending cash overnight to the government, but you have to compensate people for, like, you have to be competing for that.
Right.
And I think if you, as I said, if you look at where interest rates are now, are they high compared to where they were in say 2015? Yes, but, like, where they were in 2015, I don't think is a reasonable benchmark for the world that we're in. A lot of things have changed, I think mostly for the better, actually, on the whole. Not everything, right? But some a lot of things have improved, like, economically, right? Um, Coming out of the financial crisis, right, we had this period of extreme, like, stagnation and sluggishness and this debt overhang, and, like, we basically cleared that out, I think. The private sector's balance sheet in the US and in much of the rest of the world was much healthier than it was. And on top of that, we have this potential productivity even if you discount the productivity gains from AI, but I don't think you should. But if you add that on top, then, like, interest rates should, in fact, be higher. Um, and, I think a lot of what we've seen in the past few years kind of reflects this. And so I mean, to your point, like, people are now like, "Oh, the interest rates are just it's unreasonably high." And it's like, well, unreasonable relative to what? I mean, if we look at, where things were in the mid-1990s, interest rates now are not high, right? If anything, they're still on the lower end. And also the
Yeah.
inflation outlook back then was different too. So, like, even if you leave that aside, I am very sympathetic
I
with you that interest rates probably would rise, and they probably rise to the extent that you think the productivity increase, the magnitude of the productivity increase, I think is what really the question.
Yeah, and I think the challenge becomes, these blanket terms that we call mandates, right? The Fed, low employment or um, price stability. I had a thought Tuesday as I was interviewing Danny. I didn't bring it up because it didn't come up, but I'm bringing it up now, which was price stability really has to happen now in assets because we haven't really had price stability in assets. We've had just hyper inflation of assets. And so this wealth gap that everyone talks about is truly, real. I'm not saying gas is too expensive or eggs didn't double or my burger is now $30 and I don't like that because those things happen too. But I think price stability there comes more from market forces than from interest rates. But if we don't raise interest, this is where I kind of got in the last week. I'm not saying I'm convinced. I'm asking you to
Mhm,
tell me why I'm wrong or right or why I should keep leaning into this. I think price stability as the mandate now really has to be thought of, and Warsh is kind of trying to figure out that as part of his mandate is in the asset side. Because if we don't do it, to some people's points, like kind of incrementally, we might have to do it all at once
mhm.
again, which would cause a 35 to 40% meltdown after whatever blow off top. If we don't do it at all, we're going to get a blow off top from here. We're going higher because there's just no like when the 10-year drops 10 basis points, but Nasdaq goes up the next day 500 basis points.
Right.
That doesn't make sense.
So this is where I think it's really helpful to, like, look at all the link because first of all, I have a lot of sympathy for what you're saying, and it's been a live debate among policymakers and economists and other outside observers for a very long time. Um, so this is not something I agree with, but just to give you a sense, like, this is the Greenspan view of this is that basically by definition, if you achieve price stability on, like, the consumer inflation mandate, you will necessarily get a bubble in asset prices. And his point is that if you get that kind of stability, if you, like, achieve not just on the inflation, but on the growth, right? If you, like, get the sweet spot of, like, there's no inflation, growth is solid, you've tamped down the business cycle, then the natural response is people are like, well, this is great. There's no downside risk anymore. The economy is fantastic. I'm just going to lever up and buy risk as much as I can. And they'll do that right up until it blows up.
Mhm.
And so, I mean, he actually said, I can't remember exactly where it was he said this, but I mean, he said it was more than once. Like, if we do a good job, like, we will get a stock market bubble and then crash. Um, so, like, now I don't think that that's consistent with, like, what a good job means. I think that's more. I
No,
think
but I
that
mean,
actually reflects, like, that's a criticism of
consistent,
what the
but
mandate is. But there's, like, there's inherently a tension though between these things. I mean, the other thing that's interesting too, which relates to this, is you can, like, forget, like, multiples obviously are a big part of this, but, like, earnings growth is the other side of this, right? But, like, what drives earnings? A bunch of things drive earnings, but, like, at a macro level, one of the big one, there's this wonderful paper, it's like just to back up, like, the Kalecki-Levy equation, but, like, it goes back, there's this, I remember one of the things we were introduced to was is the Levy Forecasting Center, like, explained this, where profits come from. It's, like, 20 years old now, this paper, but the idea is to go way back. But basically, in the aggregate, the biggest, most reliable generator of corporate profit growth is corporate investment. Now you can see what the potential problem is, right? Like, if companies are, and the reason is, like, one company's investment is like an asset that depreciates slowly. It's another company's revenue that shows up immediately. So that creates aggregate profits in the economy, um, which is great. That's like how growth comes from if the investments are good, right? The problem is if you have a situation where a lot of companies are investing a lot in stuff now, generating profits in the aggregate, uh, that encourages asset prices to go up because the profits are rising, which encourages more investment. That's not a problem if those investments end up being worthwhile. But there's a feedback loop here where the more you're generating earnings growth that generates the higher asset price, generates more investment. You can have situations where this gets overdone, right? And I think it's not very hard to see think like, well, is this happening now? Maybe, right? And so that's the challenge, right? So, like, you can say you want to tamp down the asset price volatility, but the flip side is that means you're going to be hitting the real investment activity as well. I think that there's a case for saying you want to do that on like you want to moderate that, right? Because it goes both ways. Because if you have the asset prices crash, then investment will fall with it. And we've seen that historically that the one of the biggest predictors of capital spending is stock prices. And so if you have a stock prices crash, then companies are going to not invest. And that has all sorts of real economy implications and implications for hiring and wages as well. And so if you think about the mandate of central banks and sort of macro policy more generally is not, full employment and price stability and moderate long-term interest rates are the words that are written in the law, but like you can interpret those things. Like the thing I think makes sense, like what does that actually mean is like you want to have stable growth. You want to
Mhm.
dampen the cycle. You want to avoid like severe downside outcomes. And so given these self-reinforcing dynamics, I think one way to think about this is it's okay to say that businesses maybe don't want to invest everything now and like hold back some of that capital spending, find ways to either discourage it or postpone it or drag it out. Because if everyone just front loads everything as quickly as possible, and if asset markets are encouraging them to do that, that creates the danger of these big swings in volatility. Not swing, this big volatility, right? These big swings in activity that then, it's fun on the upside, but it's really destructive on the downside. And I think like longer term, it'd be better if you just kind of dampen that cycle. And so that I think I don't know if people at the Fed are talking about this way, but, like, I think that that's
I did
relevant.
it's such an interesting so I'm gonna throw a couple other, quandaries that a smart guy like you can maybe help me synthesize because this is what my brain noodles on, and I try and help people understand. The roller coaster is real, right? So the volatility, my humble opinion, again, I might not be right. Volatility is here to stay for the next 3 to 5 years. Like, I think we have bigger swings up and down. I think we recover faster probably than people think in some ways too, but I think we're just in for volatility. An example of that between my friends, I haven't published about this yet because I don't really know what I would publish yet. But I said to some of my smart money friends like this week, this is a canary in the coal mine. It was the Airtable deal. I don't know if
Mhm.
anybody's seen this or not, but like you
Yeah,
might be familiar with it, right? So Airtable, right when you were starting your Substack, Airtable closed their last venture round at a just under $12 billion post money valuation. It was like
yeah.
11.7 billion in 2021, December of 2021. And they just got bought recently by
Mhm.
Bending Spoons, which is a private equity shop known for
Right.
buying distressed deals, and they got bought for basically 1.25 billion when you factor in the fact that they paid 2 point whatever to something, but there was 965 million on the balance sheet in
Right.
cash. So when you add that back in, you basically
Right.
you bought this for 90% off. Now, you say, well, what's happening at Airtable? What's did they stagnate? Well, they're growing at 20% a year. They threw off $480 million last 12 months in ARR. So that means next year they're going to do somewhere around 600 million in revenue. They're profitable because they haven't dipped into that cash very often. If you put any kind of multiplier on their likely EBITDA, they got bought for 8 to 9 times EBITDA. That's what you buy a sandwich shop for that's well run in 1998 is 7, 8 times EBITDA. A technology company just went for 8 to 9 times EBITDA with $500 million worth of recurring revenue and 20% growth. Something doesn't add up. Now, I say all this through the lens of interest rates are where they are. Too high, too low, who knows? If you're trying to roll over the national debt on short term and recapitalize it, you want them lower. If you're trying to stop from a blow off top and insane whatever, you need them higher. If you're trying to manage it too, you're in this quandary. You have 7 trillion plus in money markets still. Record time, high, cash just sitting there waiting for a good idea.
Mhm.
But then you have all this dry powder that funded these things at valuations that obviously made no sense, right? So help me understand how we raise interest rates when we have those two tug of wars happening. And that's just a financial economy because real people, 8 billion of us, just want to know what it means tomorrow at the pump or in our small business, or if we can afford to hire someone, or if the bank loan's going to double, or, you know, I mean,
Yeah, I mean, I think that the example you mentioned is interesting because, of course, using 2021 as a reference point is gonna lead you to a lot of, you know, unusual I mean, in some ways, I don't know
right.
how much the Airtable thing is, like, a lagging indicator, right? Because there are a lot of, you know,
Yeah,
you mentioned I live in San Francisco, right? Like, I know a lot of places that they had 90% drawdowns from peaks in 2021. Um,
sure.
and some of them recovered somewhat since, and some of them didn't, right? But, like, I don't know. I mean, that's, like, a tricky point. But, yeah, I mean, that's a big question. Like, I actually
Well,
am
and
not
AI and
worried about
productivity,
oh,
what we don't know is what we don't know is that just what that business should be worth? Meaning it's a hell of a business, and the last round, you know, was part of a stimulus money,
mhm,
drunken expenditure, so nobody's fault, but the business is healthy and it's at a discount. I think 8 times EBITDA on a business like that is a steal, so good job Bending Spoon. And that's kind of what they're known for, I guess.
yeah,
But, at the end of the day, even if it goes to 12 or 15, like I think, okay, maybe they just bought a healthy business. The other side of that would be no, AI is going to come kill that. It's the SaaS apocalypse and this is your
right,
canary. I don't know that I buy that story fully with something that's infrastructure wise because implementing it, getting institutional buy in, those source of records, these things are real, right? Going headless is not a big deal. Salesforce made the announcement kind of before everybody else. We're going headless. Like our API is going to be the UX. Okay, well, that's going to make sure you don't see churn because I spent 20 years putting my stuff into Salesforce. Now you're going to give me the UX I want. Why would I change the infrastructure, right? I'll just
right,
keep paying my annual subscription. So I think that SaaS apocalypse is overplayed. I think there's a buying opportunity in SaaS for private equity shops. Maybe that's what this is. But at the end of the day, it all kind of plays into this dynamic that is perplexing, right? Which is
mhm.
too much free money for too long, hiked rates too fast when we did it. Now we are in this argument of whether they go lower again or whether they go higher.
Yeah, I don't know if we did high grades too bad. I mean, like, the thing that I think is interesting, and this sort of gets back to what I was mentioning about, coming out of the pandemic, but I think a lot of people were afraid that the pace of rate hikes that we did and we saw in 2022 and in 2023 would push the economy into, like, a severe downturn. And I think what happened was that the things that had been holding the economy back up until that point were sort of cleared out by the pandemic and by the response to the pandemic, which is if the problem coming out of the global financial crisis, both going into it and coming out of it, was this big overhang of private debt. And you then have the government give, trillions of dollars in checks to people and on top of like inflation and everything. And then that's not an issue anymore, basically, right? Like people, like we've not, like the role
Seen
of
it now
debt
though. I
growth.
mean, again, I don't want to misquote data sources, but I mean, I've seen stuff around 90-day default rates on subprime auto going through the roof. Search terms in Google 6 7 months ago, one of the top search terms was how do I give my car back?
Mhm,
Because again, a whole generation they can swipe right and left for everything. Goes, I don't think I want this anymore. Forgets about the 30-year term or
mhm.
36-month term, right? I I just I don't know, like I kinda I wanna understand the data
Well,
doesn't say, "Hey, household savings in '22
mhm,
were at an all-time high, and we went and did the GameStop thing, and everybody became
mhm.
a speculative investor, and look at how great it was. That's awesome." But now the spending continues at IKEA and everything and Target every weekend. I see them in there, but they're using credit cards now, so the data's
Sure.
showing that that's
Although
rising.
credit card debt so what's interesting, like, so I mean, credit card debt rises over time as the economy rises over time. Like, if you look at credit card debt relative to incomes or relative to spending, it's still actually relatively low. If you
Okay.
look at it relative to the pre-pandemic trend, it's still relatively low. So, I mean, part of it is like there's this lagged inflation effect, but it's like
Mhm.
that actually interesting. Like, if you look at the debt growth, this is something I've written about before, not like look like 6 months ago or something, but like debt growth relative to spending growth is still actually extraordinarily low. That as that in that increment, like there's been this sort of like basically debt growth was low after the financial crisis, but the difference is that spending growth was also low, and now we have spending growth
Yeah.
being much healthier, but death growth is still just as low. Um, and that's the difference is that wage growth is higher, right? That like it's just systematically higher and faster now than it was before. That's generating more inflation to a certain extent. I mean, I personally like it's funny. Like I write a lot about inflation being higher than what people want. Like that means interest rates should go higher. But like I actually don't think this is a problem personally. Like if you look back at what everyone was writing about, or many people were writing about, like say 2018, the big complaint people had was interest rates are too low. Interest rates are too low because the economy is too weak. We need to figure out how to get interest rates higher sustainably. We probably want to have a higher inflation target than two, or not even. And the Fed wasn't even at 2% inflation. Like we want to have like higher than that. We want to first get to 2 and then see if we can push it higher, or like have some kind of like nominal growth target in general that's like 5 to 6%. We managed to actually get all those things right, like, and now everyone's mad. Uh, Weird, but, the people you actually got what we wanted,
Well, I think people are mad for good reason, right? They're mad because the majority of them didn't benefit from that.
well, no, I mean, even the economists who, like, pushed this, I understand, like, other people being mad about it, like, that's a different story, right? Like, they weren't like, that wasn't what they said, but, I mean, even a lot of the economists who pushed this idea, like, many of
Yeah.
them seem to think, like, this was a problem, which is interesting, like, that's like the more tricky challenge. Like, obviously, people who weren't participating in those debates and saying, like, "We should have more inflation," like, it's understandable why they might not like this, but, like, someone who said, "We should have 4% inflation," as, like, a more like, suddenly being mad that we have 3% inflation, like, "Oh, no, this, why."
Yeah, I mean,
That's
I
a different
think
story.
and all that stuff to me, I guess, I agree with you. I think for most people, it's just noise, man. Like, the dollar debases, it's fiat currency. It's designed to go to 0 over time and get replaced by another fiat currency. That's what by decree means. And so if you look at the Federal Reserve's, dollar, it's averaged 3% a year, like inflation for 112 years, right? At $97 drop from $100 bill in 1913 to 3. You can go to your phone's calculator and it'll tell you exactly. But there's years where it went up and down. So the point that you're making is when they're saying 3% target, they're trying to smooth out what happens anyway,
Mhm.
right? Because it gives guidance, it does all those things. But for most people, they don't it doesn't mean anything to them, right? Because their meat's 28% more. And so
Well,
now they're eating chicken or
yeah, although
whatever.
I think the thing about that's a little tricky, like, it's worth pointing out, like, a physical dollar bill has lost a lot of its value. If it had been earning, like, a money market rate of interest over that time compounded, we
Right.
would have a different picture. I mean,
Sure.
certainly there were periods of time when that was
But
not
that's the difference between
rewarding, but
consumption. That's the difference between consumption and investment, right? The entire economy, 70% of the GDP is based on you and I not putting our money to work. It's us buying stuff. And so I'm not arguing with you. I agree. Like you could stabilize that degradation of spending power if you had just left it in a money market or whatever, right? All the different things. So that's true. But the instrument of currency that it represents, which is to drive 70% of the GDP through consumption, doesn't go to work for me. It
correct.
gets spent.
But it's not supposed
So
but if it gets spent, then you also don't mind that it lost 97% of its value because you weren't holding on to it for since 1913,
that's
so
also true.
it
Fair
it
point. Touche.
balances out, but I mean, also, I
As long
mean,
as you bought something, as long as
well, that's the
you
point.
bought something,
If you're using it right away, you don't care, and if you're not using it, then you
right?
can get a better return. I mean, obviously, there are
Sure.
periods of time when inflation, is not compensated for by yield. Obviously that's like a problem, but in general, it's not necessarily. I mean, that's like there's all sorts of questions about how you invest around that and how you
What
manage
about
the
the
economy avoid it.
healthcare component? Because consumption, like I like what you said there, but like I've seen numbers, and again, I don't. This is not me saying this is fact. I've seen numbers
Sure.
where I think healthcare was somewhere in the neighborhood of 27% of all consumption. Obviously, with boomers aging, consumption could be going up, but could be somewhat of a false flag because if it's because healthcare spending is going up because an aging demographic is shifting where they spend their money, and that aging demographic has the majority of the wealth from the last 20, 30 years of accumulation, that doesn't necessarily mean the real economy, productivity wise, or in your town is feeling better. It means that healthcare is offsetting, just like the Mag 7 offset 493 other companies
Mhm.
in the S&P.
Yeah, that's certainly
Is
a
is health
possibility. We haven't seen that
oh,
happen yet. We have not seen that happen yet. So actually, what's interesting is that health spending as a share either of GDP or as a share of consumption, it actually, it basically has flatlined
Okay.
since, sorry, I just wanna get the exact number here for you if I
Yeah,
can.
yeah, no, I can see
Uh,
you looking at the chart,
but
which is always nice.
sorry, I have to well, actually, I different ships, I can look at this. Yeah, it actually, it's like it's not intuitive that this would have been the case, given
Yeah,
the
I'm actually
narrative. Basically,
surprised
and,
it's
like,
flat.
why this is a different question, and, like, some people say it has to do with various cost controls that are put in place, as part of, like, Obamacare. Some people say it's other things. I'm not gonna pretend to know what the explanation is, but let's see. Yeah, it basically it hit as a share of, consumer spending, healthcare is currently at 17%,
Mhm.
and it's been at 17% ever since, how far back do I go? 2010. So it's
Okay,
actually been flat around 17, like 16 and a half to 17, sort of wiggling, remarkably consistent. There was a huge increase up to 2010, and then it's basically been flat. Which
okay,
is, yeah,
the
definitely
growth
surprising given what we know about demographics and everything else, but basically that's what we've seen. That
interesting.
could change in the
So
future, but that's where we
sure,
are as
yeah, but
as of
that's
now.
good though, so that was a misnomer because I couldn't remember the source, and it may have just been some FUD on the internet. So, again, I didn't wanna anchor to it. I just knew it was a significant component. I
Yeah,
thought
no,
it
it's a big
was as
chunk,
high
yeah.
as 20 something, so if it's been flat for 16 years, that's interesting
Mhm,
because, why again, I think why matters, but maybe not. I think just the point is it's flat for almost 16 years. That's not what I think most people's assumption would be if they have looked at this. So mine just got changed. The question is, does it matter if it grows from here as a percent? Is it a misleading indicator if it does all of a sudden grow again to 22? Or does interest rates not impact it at all? In which case we could say, well, like look at the other 83% of spending
mhm.
and what would higher for longer or just holding here for longer mean to those spending classes, right? Like those assets or consumables, I guess is the word I was looking for. So, the millennials are definitely doing their part then picking up the slack if healthcare's been flat for 16 years.
Yeah. I mean, I think your question is a really interesting one because the mechanism by which changes in interest rates flow through changes in inflation is not obvious. It's not obvious to me. It's not, I mean, if you ask people like how it works, like the most straightforward answer that I hear from people, um, and I mean like this, like Fed people, and you get different views, but the most straightforward one is like, look, interest rates go up. It's more expensive to buy a house. It's more expensive to do a cash out refi. More expensive to buy a car, and maybe businesses won't like hire as many people. And so that's and maybe the dollar goes up, and so like exporters will get hosed, and maybe imports get a little cheaper. That's basically how a lot of people see it in the short term, and like everything else is kind of noise. Um, there are other arguments you can hear for other explanations, right? Those make sense to me intuitively because you can see the mechanisms. It also, if you think that those are the mechanisms, you can see why it's kind of arbitrary and unfair. Like, why is it that like our entire inflation fighting regime is basically, screwing over housing every once in a while, maybe some manufacturers. But that's, that is a view. I don't know if that's there are other interpretations, right? Another view could be like you increase the discount rate on stocks, and so there's less of a wealth effect, and so people are going to spend less out of that incremental gain than they would have before. That's certainly possible. I don't know like how much that's true, but like but then there's also the argument you hear, and I don't know, I don't find this super persuasive, but it can be like, well, interest rates go up, the yields go up on assets that people have that are floating rate, and then they're actually richer, and so there's not any that either offsets a bunch of it. Like I don't know, right? Like I think it's a very complicated thing. I think that like we don't actually have a lot of good insight into how these things
I
work.
think what's amazing about it is I think most of it now is just weaponized to sway a voting bloc versus actually understand what the functional economy could look like. Because again, I think a lot of it is noise. I don't know. I just think a lot of it is noise, and that's what we're trying to find the throughput to, which is so like I read a lot about right now. This Cerulli talked about the $124 trillion that's going to change hands over the next 22 years because of generational
Mhm.
transfer, right?
Sure.
And
Yeah.
again, it's not saying that your kids are going to get it. It's saying if you plan right, then you get to probably decide who gets it. If not, then the state will decide or a predator will decide. So one way or the other, though, regardless of whose hands it lands in, 124 trillion is changing hands. And a lot of that is tied up in real estate. Maybe it's mom and dad's home that they've owned for 30 years that they bought and paid off over time and now is
Yeah.
worth 3 times what it was 20 years ago.
Mostly not though, for what it's worth.
Right. So most of it's where in the
Stocks.
IRAs and the four, yeah.
Yeah.
So maybe there's not a huge impact on housing then, because the part of the thesis is, well, what happens when, a bunch of Gen Xers inherit properties that, you know, maybe they'd like to keep them in the family, but their kids are in college paying tuitions, they got other bills, they're whatever, they're not certain about their own job security, and they just would like the cash. And like, what happens when those houses enter the market over the next 12 to 24 months from whoever is in that cohort, and interest rates are higher than they are now or where they are now, and they can't buy down the rate like a builder? What does that do? Does that create opportunity for resale buyers that are like looking to get a deal and someone who's happy to exit and just have the problem solved for 20% below market? Does that reset comps in a normal, healthy way? Does it create a problem? Like again, these are, or does it just create a stagnant again market where we have more people wanting to sell than people that want to actually own? Which I could argue that. Like, what are your thoughts on
I
where
mean,
houses?
these are all good questions. I think one thing, there are a couple points here. One is that I think where the houses are and the quality of the stock is going to matter to a certain extent. I mean, one thing, I live in
Sure,
San Francisco, which is kind of an extreme case, but like it is the extent to which people will buy a house that is basically like tear down ready and then will like just tear it down. Like they'll spend a lot of money to buy it and then they'll just spend however many years and dollars just like completely gut it and rebuild it. So like that, there might be a lot of that going on, or might end up
mhm,
happening, right? If something hasn't been updated, that's certainly a potential issue. And like the implications of that, I mean, in some ways that's actually stimulative, right? Like because if you just sell a house to someone else, like there's like I guess the broker gets some money, right? But like otherwise, like
right.
there's not like activity. Whereas like if you have to hire like all these contractors to rip everything out and put new stuff in, like that's jobs. That's so that's potentially a thing to be
Yeah, you
mindful of.
could argue it's stimulative in a couple ways because, it's not necessarily GDP can be a head fake as far as the national wealth, but it also is still a driver. So if all of a sudden now you buy something, you tear it down and you try and rebuild it, that means electricians and plumbers and
Right,
drywallers. But then, oh, by the way, we still have the CapEx spend. We don't have enough electricians for that.
right.
So now you have this whole movement into trades that's already started, but now there's another way to execute it that isn't fully relying on the AI trade. It's just based on this fact that $5 trillion a year for the next 20 years is going to change hands. And a portion of that's going to be people that probably rip
Yeah,
down a house and put up something they want. Right.
yeah.
And so there's job creation in the trades in those markets, wherever those markets may be, that could be stimulative because
Yeah.
the demand and supply might be out of whack.
I think the other thing though, to your point is like on the interest rate side, and this get back to what you were saying earlier, is like interest rates right now are not high relative to they were when you were buying your starter house, right? And
Right.
so I think part of the reason why you've seen, and this is speculative, but I think makes sense. Like I think the reason why interest rates have felt high for housing and seem like they've been this big, you know, headwind to transactions is because people are still anchored to the pre 2022 world. And I think eventually people will just get over it and be like, okay, 7% on a mortgage is not crazy if NGDP growth is, 6.5, right? That's actually not, it's like very
Yeah.
reasonable. And so, like, especially as a lot of what you're talking about, these transfers are going to be in the future, I think assuming things don't change radically, like people just get more and more accustomed to it and then it
It's
won't be a
it's
big
a
deal.
really it's a really good reframe, I think, for everybody to just kind of think through their own plan and kind of where they are in life and their horizon, their investment horizon. Because like when I think about it based on that, I go, thank God interest rates were at 7% when I bought my house. And thank God I bought it when they were going lower. Because when I bought it in 2000 or whatever, right, I paid 7% interest. So my house was $206,000 and I could afford to get in it. And then I sold it 26 months later for 355,000 with an all cash offer and it arrived before I even had the MLS pictures up. That would have never happened if I bought it at 2 or 3%, right? Like I would have
Right.
the reason why I made that appreciation was because I bought it in a higher interest rate environment before there was something that happened that required them to rapidly lower rates and move the capital around asset classes. Now, I'm not saying it's going to happen again. I'm saying that you could argue part of getting to a healthy kind of economy again is keeping rates where they are, maybe raising them, getting everybody to realize that 3% interest mortgage, 2.5% interest mortgage might happen again, but it ain't gonna happen tomorrow. And so
And
when it
and also,
happens
if it does happen again, it's probably because something really bad is going on in the world.
right, right.
Like, it's not that's not a situation where things are good, and so, obviously, it's great if you have a house and can refi at that rate, but, like, it's not something you should root for in kind of a general sense.
No, but if you're wondering where the opportunity is, the opportunity might be to be sit, wait, you
Hmm,
know, make your 4.5%. And if rates go up, you could be even more patient because now you can make 5% in your money market and you can wait for sellers in whatever the asset is.
right.
I don't that may sound a little pessimistic. I don't but at the end of the day, like nothing grows to the sky. Nothing goes up forever.
Yeah, I mean, I will also just say, though, like, well, there might wanna to be a case for patience, like, in general, like, things are actually pretty at the macro level in the US economy are, like, pretty good.
I
And
don't
it's
think a
feeling
lot of people think that, which I find
no, I know,
I I
but
I think I agree with that too. I'm not saying there's not challenges, but when you think about how much manufacturing we're bringing back on shore and how those are not like commitments that you walk away from 6 months after you do the press release, because if you do them and you start them, they take years to develop, and then you're gonna have to get your money back. So, when you think about some of the moves, whether it's what's happening in Arizona or in Austin or whatever, these are decade-long, 15, 20-year moves that are in place, they're in motion. So whatever you think is good now, you could argue is going to stay strong for another 10 or 15 years simply because that bet's been made. That horse left the station and now has to earn.
yeah. I mean, one thing I think has been interesting, and I've been looking at this a little bit, is this caught me by surprise. The extent to which the length of the work week for manufacturing workers and the amount of overtime hours that manufacturing workers are putting in has really been going on a tear the past like 2 years. Going
Like
up.
growing, like getting
Yeah.
long.
Yeah. Yeah.
Okay.
So like it's not like record highs by any means. But there's been a big shift. And you've seen this also with like industrial production for certain kinds of things. And like we're not in like a boom, I don't think. Like if you kind of like zoom out and like what the data, like this doesn't it's not like, wow, this is but it is
Right.
notable and it is interesting. And like it's one of a whole bunch of indicators that's
You could
consistently
argue that
been
we're not in a decay, we're not in a boom, but we're kind of showing consistent
right.
accretive growth to a number that drives productivity, like that is tied directly to wage
Yeah.
growth. Interesting. And we're a decade away from having a billion humanoid robots with tacit,
Uh,
hands and dexterity that aren't building spaceships to Mars or Teslas. So, we've got 10 years of kind of that labor force before the robots start doing the jobs,
yeah. It
right?
depends. I don't know. When I talk to people who do this stuff, they say like the dexterity of human hands are basically like the last thing that will be replaced. So, you
Yeah.
know, chefs, surgeons, people who fold laundry, like that's you'll be set. Washing dishes, and if you're not
I
using a
mean, these
dishwasher
aren't
already, like
necessarily the jobs that
those
people
are
aspire to, but you could
no,
argue,
I don't say no. This is not
but
necessarily
like again,
benign, but yeah,
back to the auto thing though, back to the macro, like a guy that was in that group was like curious about AI, starting to get serious, hadn't really deployed stuff, but was looking at buying essentially a Main Street business, and they did like auto glass and tinting and
mhm,
that kind of stuff, like aftermarket work, right? And the concept of, oh, but what if like the robots take over? And I'm like, he's like, it's never gonna happen. He's like,
no,
I do vehicle wraps, and like the level of detail you have to do to not get a bubble in that thing, like we are. And I said, and
right,
guess what? We're not gonna take the first billion humanoid robots and go put them on Main Street's vinyl
no,
wrap business to deploy. A, it won't be cheap enough, and B, we'll put them at war. We'll put them in space.
right.
Like these things will go
There's
to
so many,
critical
yeah,
functions,
right,
right?
and because they don't, yeah, and they're not good at it. It's like this, right? Yeah,
Yeah, and even
like,
if they were good at it, you're not going to put them there first. So the reality is I think there could be a really interesting boom, and not in the stock market kind of bubble boom, but like a really interesting boom that happens in just homegrown mainstream businesses, human to human
mhm,
interfaces,
yeah,
where we leverage some of these things to to give ourselves more ability to be more human in the business versus create another tech startup. Like I think that that transition of wealth where 33% of boomers don't have an exit for their small business and maybe it's not a professionalized organization. I think you're seeing movement there. Again, I anecdotally it sounds like it's a lot bigger than it is, but I think most people live in their local economy. They don't live in the financial economy. They have
Mhm.
assets in the financial economy. And I think they could be bullish if they live in a place that they love
Yeah.
and they looked out at their, their
Well,
next 20 years.
you've reminded me, there's talking about how a lot of people don't feel good about the economy, right? There's a survey, I can't remember, I think it's the Fed does it. And they basically say, like, how do you feel about, the national economy? How do you feel about, your local economy? And how do you feel about your personal circumstances? And like these three lines are totally different. People's personal circumstances are like, this is great. Just as good as it's always better than ever. Local economy is like, it's okay. National economy, terrible. It's like there's probably you need a psychologist to explain that one. But like
Well,
I
no,
think
you know,
that's revealing about like okay, if
you,
like most people
you
think their
just need to
personal
know that a mobile phone, yeah, you just need to know that a mobile phone and every social media algorithm has polarized this into red
right,
or blue or
right,
staunch independents who just want to be heard for, being rational. And like, we're just all polarized
right,
to have to explain why we can agree with something that everyone hates.
yeah,
And again, it doesn't matter whether it's red or blue, right? Like if you talk to people about where it was in 2020, they're going to say it was horrible, and then you could find data that supported that. Uh, if you find out what's good now, God forbid you got to give credit anywhere. It's like so when you think locally, you demystify that because you're not worried about endorsing a candidate.
right,
Most people
right.
don't even know
But
who's running
that's
the
it,
city
I think.
council.
But I think that's useful though for thinking like how is the economy actually doing? And at some level,
Right? What's
people are
actually happening?
right. People at some level are able to like look through this and say like, well, if I'm okay, then it must be fine, right? But their overall sentiment is something else. But
Yeah, and I think, and again, where does it head? So your takeaway, I guess, for folks today, practical takeaways, like as the institutional people that subscribe to you, are looking for one thing. So what are your takeaways for them? The everybody else that is listening to this and sticking around, thanks for being on the live. Thanks for listening to this on a replay. If you are, what do you have as practical takeaways for them if they are, a family that is midlife, is invested in the markets, maybe passively or talking to their advisor and wants to just know some questions to ask, make sure that they got their head on straight? Like, what are some of the practical takeaways that your research and work and writing, are illuminating for you that they should think about?
so first of all, as a caveat, I have learned through experience that active investing is not my strong suit, and so I'm very much like a target date retirement Vanguard guy. Not you know gonna give
And that's okay because the
yeah,
reality is that's most of this audience and or
yeah,
the people that serve that audience are this audience. And so that's most people. And I think that's relevant because it's a good disclosure. We have people on that are actively trading, that are that are doing everything else. Those voices are on this show as well. But I like the fact that you're kind of representing it from I'm a target date, long term guy. But here's what I think the short term leads to, what that could
yeah.
mean. So what are you doing, I guess, with your own advisor or your own practical advice on um, assessing where the opportunity is and where to allocate or where to, what alts play in your
Sure.
personal mix?
All right. So zooming out, like in general, economies grow over time. In general, risky assets should outperform cash over time. Uh, in general, you want to have some cash on hand for unexpected expenses or whatever. So, like a balanced portfolio, if you think about everything you have, should include like something in a money market fund just in case or whatever. That could be opportunistic if you see something is cheap. It could just be like someone loses a job, healthcare, like who knows, right? Like, so like how you balance it out is partly a function of your own risk preferences and your sense of what your expenses are and all that, right? But like that's at a very high level. But like in general, being invested and continuing to invest over time is will work. Obviously, over certain periods of time, that will not. And like, I'm sure there's a situation where I will say this, and then everything goes down for 5 years. And then I sound stupid. But like in general, like this is I think useful ways for thinking about. I mean, that's like how I do stuff. And like I'm not gonna say it works great, but like it works okay. Um, in terms of how the economy is doing and how that relates to asset markets, like that's also can be not intuitive. Like periods the economy is doing very well and asset markets do okay. You have periods the economy is doing only okay and asset markets do well. I mean, there are a lot of moving parts there. But again, over time, these things kind of balance out. I mean, what I will say, and I've said is like, I think actually, despite various outside or inside shocks or whatever, like I think actually the fundamentals of the US economy are still quite good. I mean, a lot of things have changed certainly over the past, say, 18 months, and that have had certain impact on certain things. But on the whole, I think if we kind of zoom out, like the post-pandemic world, like the extent that we had the financial crisis, which was a tremendous shock, and then left a burden of excess debt that hampered growth for a long period of time. I think the pandemic in response really fixed that, and I think that fix has been really growth positive for the US. And I think that, and for a lot of other countries as well, to varying degrees. And I think that that's still true. And I think that tailwind has mostly continued to offset any other headwinds. I think that has implications for where rates should be. And if you have views on how interest rates should flow through other assets like that, that could matter. But like that gets more in kind of a, you know, discretionary asset pricing view than like just buy things. But
Do you make any black swan, I don't think it would be a black swan at this point, but do you make any like anomalies in your caveat being bad times could come if we see a private credit blow up on the CapEx spend? Like, or do you kind of have data that says, yeah, I mean, again, I think people are
so like I don't think so. Private credit is not very large as a market, as far as I can tell. Like, I mean, there are estimates that make it look a lot bigger, but like the things I've read is it's like 2 trillion, I think, right? Um, Total debt in the economy is on the order of tens of trillions, so it's just not that big. I don't think it's all zero. So again, like the losses there, in principle, I mean, again, I don't want to like get over my skis here, but like in principle, I think private credit is actually an improvement over other forms of credit we've seen historically, where you think about like a bank loan, right? The bank, there's some equity. Mostly it's financed through either deposits, some of which are insured, some of which are not, or things that are deposit like, where people expect there's essentially no risk. And so if they lose money on their loan, a lot of people who are really not expecting to lose money get screwed. And moreover, a lot of those people, they're lending essentially not even overnight, like intraday, right? You can just pull your money out whenever you want. And so if people get concerned, they can pull their money out very quickly. And that can become self reinforcing. So even if there aren't any acute losses, if there's the threat that there might be losses and you know if people pull their money out, whole thing blows up, right? And that's a very fragile system. And the way we as a society have dealt with it is a kind of a weird kludge of like, well, we're going to insure a bunch of deposits, but not all of them. We're going to have the Fed make lend loans stuff anyhow. And like it kind of works. Sometimes it doesn't work, but like whatever, it kind of works sometimes. Sometimes it doesn't work. Financial crisis did not work well, right? Um, Private credit in principle actually solves a lot of this problem because instead of short-term deposits where people aren't thinking about it, you have uh, in many cases insurers who have very long-term liabilities. They are not there's not leverage really. It's just like they put the money in and they hold on to it, and then maybe there's a little bit of borrowing against it, but not like nearly as much. Right? Like do you think about like bank equity, you're talking like 10 to 1 leverage, 20 to 1, right? Like insure the private credit, it's more like 1 to 1. So in principle, like it should be a lot safer for the financial system as a whole. Obviously, like maybe that will not turn out to be true, but like we have
yeah.
seen already withdrawals and losses some in some funds, and it hasn't really spilled over.
I feel like again, it could be if I wanted to convince me for further around the camp of we should raise rates another 150 bips over the next 18 months and just tell everybody to get used to that normal again. If I wanted to really go hard on that, I think private credit's the another example. And I'm not saying that it's not a risk. I'm saying it's not healthy. There's a lot of stuff that is just toxically broken around the deal structures that those private credit funds are invested in. I wrote about Blue Owl and Meta and all this stuff. And there's been a lot of coverage lately around this whole leasing thing, right?
Mhm.
$99 billion profit that Google printed, but they went negative
Right.
cash flow and 20 years of leases. But it's like it's all the stuff we did with Enron and things like that in theory, but now within the letter of the post Enron era
Mhm.
and post Dodd-Frank era, where it's like now legal to do these gray area things if we write them a certain way. I think there's a lot of really toxic sludge there. I think some LPs that don't know they're in the LP mix are exposed to it. So I concern myself a little bit. I think there could be, again, a volatility
Yeah.
hit. I
I
don't
will
know
say
that
private credit's not good
it's
for
systemic.
retail.
Yeah,
Sorry, like
I don't
I don't
think
think
it's
that makes sense.
systemic. Right. Yeah, I don't think it's necessarily systemic. I do think that the argument for higher interest rates is a good one on that alone because we stop inventing these kind of gimmicks and financial engineering games to deliver against that hurdle rate when the interest rates are more stable, like when they're a little bit higher, because now you remove the incentive to go chase 15%, in a private
Yeah.
credit type bond because you have a way to get your 6.5 somewhere else with less risk. I think that all those things could play out. And like you said, I'm not sure that it's systemic or not. I do think it'll create volatility though. I think we'll see
Right.
potentially a moment where it could be bad.
Yeah, I mean, I guess I would reframe I think everything you said makes sense. I guess I'd reframe it as, like, it's not so much private credit per se, but just, like, we are in this investment boom that is being financed with debts, however, they're structured, and, like, that is showing up in things like, negative free cash flow at companies that used to just print print money, right? And so, like, that I think is one way you kinda can if you wanna look at it at the macro level, you can kinda cut through that. Obviously, looking at those sort of specifics of the plumbing is very helpful if you're worried about particular blowups, and as I was saying, like, I think the promise of private credit, what made sense to me when, it was emerging as an asset class, I thought, like, this is an improvement over what we did banks, is like, the money is locked up until the loan matures. That's a big part of it, right? You don't have this duration mismatch. If you have a situation where you have a private credit fund that lets you pull your money out every quarter, it's like, that's not that's not an improvement, like, you didn't fix anything.
Right.
Um, like, that's not what it
You
was
just
supposed to
changed
be.
you just got rid of the regulators, right? You just
Right,
got rid of some of the regulation that
right,
prevents you
and
from
s
being floppy
right,
because
and
now
s
you put it into a different.
right, and I think that's the problem, like, I think if you were to sell it to retail as, like, you literally can't pull your money out, which I don't think a lot of people would go for, or if you just stick it with it as, like, this is a particular kind of product for a particular kind of institutional investor with a particular, you know, asset liability matching needs, then, like, that works fine. I mean, I think it's a useful innovation actually in that world, but I think that's sort of the challenge. But again, like, if we're looking at there's this huge CapEx boom. It's showing up in various ways of companies basically burning money in new and creative mechanisms, whether it's as I said, these least, structured SPVs you're talking about or other things. Like that is also um I mean, again, how destructive it is. I mean, the fact is like the Googles of the world have enough cash and enough cash creation capacity. If they want to, they can do it for a long time without it being a problem, right? I mean, the interesting, whether they choose to in some ways is more they keep doing it. It's like that's like where it gets interesting, and that's where like, well, what's the return on these investments they're making, et cetera. But that's where it gets a lot harder, and I don't. None of us really have any great insight on like whether it's good
I
good
think what
value.
I think some takeaways for folks, and I want everybody that is not subscribed to you to subscribe, follow you, do all those things, upgrade if it makes sense. Because I think that, what's interesting about this conversation, we've kind of gone into an area I've been really poking at and trying to get in the conversation at large with all these interviews, which is understanding what I'm looking at and like what impacts what, right? So in other words, like when we're talking about these things in the macro and we're thinking about financial economies, there's an impact to anyone who's got money in the markets or money in savings or money in a house or whatever. So you should probably understand that. But then people kind of go, well, I don't know how to translate that into like, well, what do I do today within my career, my job, like what or where I live? But I think what you're hitting on is kind of the fact that like if you take this target date kind of approach, whatever that target date is, maybe it's just when you want to be financially free where your money's working and producing as much income as you work and you have the option. Maybe that's retirement, but you're going to go do a hobby or you're never going to stop. Maybe it's retire on the beach like everyone used to think. Whatever it is, doesn't matter. You have this target date, it's usually out there in the future, 10 years, 15, 20 years. And if you think through that lens, you're trying to look at, well, what's actually happening? So are more jobs coming back home? Is more infrastructure being put back home? Is this inevitable? Meaning, like, is AI going back in the box? Or is this the arms race to end all arms race? And are we investing in that? And if you think it's inevitable, then you go, well, I don't really care what happens tomorrow. If we get the next global crossing, so be it. What we're now decoupling is the capital structures underneath the inevitable thing and your target date. And the capital structures can fundamentally be broken at any given point. And they are, in my opinion, in several areas. I think venture capital's capital structure was broken. We just evidenced it, a 90% drop. The asset is still there. The cash flows are still there, but the capital structure was way ahead of itself, over your skis, to use your analogy, right? CapEx spending on AI, inevitable. We need to do it. It takes years to build nuclear power. It takes years to build these data centers. So we have to start. But is the capital structure right? probably not perfect. A lot of stank on it if you look at some of the private credit SPVs that are out there. So understanding that the capital structure and the thing itself can be two different things is, I think, the takeaway, right?
Mhm.
What is the actual thing, and is it long term going to be something I want to be in? And then what capital structure am I using today to access it? Is that sustainable, broken, or fool's gold?
Yeah.
That's the
Well,
discernment that
this
anybody
is
needs regardless.
this is where I'm gonna once again, you asked me about books. Volatility Machine by Michael Pettis is all. I mean, he's looking at like the sovereign debt level.
Yeah.
This was written in the wake of the late '90s emerging market crisis. I mean, he now does all sorts of other things, but like he cut his teeth as like a LatAm banker in the
Okay.
'80s. So like that's his sort of like where he's coming from, and then, like his whole point is, the capital structure actually can affect your judgment of the underlying asset because it changes the behavior of everyone managing it and building it, and like it can, on the way up it can make things really good, and of course on the way down it makes things a lot worse, right? And so that
Right.
so like the capital structure isn't just this like thing on top that you can kind of ignore. It can be in fact extremely important for thinking about like what the path of economic activity is. So like we're thinking about and this is what I was saying earlier, and is consistent with what you're saying. Is like if we think that this investment is fundamentally good and worth doing, but we don't want to have like this crazy set of bubble and bust and volatility in the economy that could be incredibly painful, especially on the way down. Like it is worth making sure the capital structures and the incentives are such that you don't have too much front loaded investment to the point that it then leads to not enough investment later. I mean, we talk
Right.
about like the tech boom and like it was fine that we had this big bubble in the '90s and stuff because, well, we still kept all the equipment later. It's like, well, actually, and what happened in the 2000s was that companies in the US, and not just the US, but in the US, like, dramatically cut their investment. There was minimal capex. Uh, and in fact, a lot of the stuff that did get built, they then depreciated it. And like, we don't, like, the reason we didn't have a chip industry in the US for a long time, and like, we had to spend a bunch of government money recently to get it back, is because the stuff that was built in the late '90s was overbuilt and the market wasn't there for it. And the demand was, because of, and that was a disaster. So I think if we're going to do stuff again, like I think be mindful of that experience. It's better to draw it out, have be more sustainable, avoid kind of the severe drawdowns. It's not actually harmless.
Yeah, I tend to agree with that, and I think, we still have some work to do or watch out for, whether we're directly invested or not, passively or not, is, levered ETFs.
Mhm.
The recognition that, the overnight and the short end of the yield, curve is just overbought right now, and that there's some work to do there to, normalize that bond market maybe a little bit, with prices. The other side that has to clear, in my opinion, is, some of this dry powder that hasn't been deployed yet, but that was raised in those kind of peak things. Like, it has to find a home somewhere. And so we still might be where we have unwilling sellers at today's actual price. We might still be where we have momentum capital into stuff that really doesn't deserve it.
Mhm.
And all this stuff has to clear, and it might take 1 year, 3 years, 5 years. I have no idea. And um, it's important to recognize that, because that way you can kind of understand maybe better what the blip is. Is this like you said, the volatility? I think it's a great book recommendation because it really helps you just understand, like, am I in, a dead cat bounce, as the chart makers would say? Am I in like, is this a 10-year thing, like it was with the dot com?
Yeah, I mean that's the problem. Like the drawdowns can be very long. It's not just that they hurt at the time, but like they can last a very long time, and that is, I think, why it's actually worth investing the effort. I mean, this is not even. I mean, obviously, there's like the people listening here where it's like, how do you as an individual manage this? But like to the extent that I write also for policymakers to think about this, like it's worth making sure it doesn't happen because it's an incredible, like the idea that you can just kind of brush past it, I think, is a mistake. There was an
Yeah,
idea in the 2000s, like, oh, it wasn't a big bubble deal, the tech bubble burst, because we can just move past it with monetary policy. But like the way they moved past with monetary policy is they had a housing bubble, and that didn't
right.
work very well either, right?
No,
So
I
and
mean,
then
that's
they,
really how they just pushed it into the one thing they had never thought of pushing it into before,
right,
and that went even worse.
right,
And,
we had a lost
and
decade after
again,
that.
when you think about that from a time horizon, that was 7, 8 years.
Right,
So, that was not a short clip of
Right.
And then when you think about what that recovery looked like, I mean,
And it wasn't really till the pandemic that we got out of that, I would argue, in
right,
a
and
lot of ways.
some people could argue that, on a nominal basis we did, but on a real basis, like
Right, which if you take that perspective, then, like, actually the legacy of the tech bust was 25 years or 20 years, right? Like, so not it was not insignificant. I mean, obviously for, like, if you're investing in Nasdaq stocks, like, some of them you made back your money sooner, but, that's I mean, that's, yeah, I think it's worth being mindful of that and, like, what the real economic costs in addition to the cost of, what happens with certain asset prices. Because obviously there's situations some stocks will go down, that's life. Hopefully, if you're broadly invested, the winners cancel out the losers, but, if the whole economy just ends up in the gutter for a decade plus, that's a different story.
yeah, and I think, the return on, if you are alternatives, I mean, I'm personally, like, I'm more interested in investing my money locally, right?
Mhm,
Because returns aside, there's more than just a financial return. Like, your money can live in Wall Street and in an ETF and whatever, and your cash can live in a money market account, and then you're kind of like your 10% or 15% of, like, what you take bets on. Like, I mean, whether it's consumption or investment, I'd start spending it in my zip code because the ROI there is immediately meaningful on multiple levels, and, um, you might be in an environment where there's deals that could 15-20%, but like, that actually are net positive to the place where you reside and where you
mhm,
walk around and meet people. I think I'm kind of the optimist in me, thinks that that's gonna be a trend that we see, that people with their discretionary investments anyway. I mean, I'll pay $8 more to go buy flip-flops at the local place versus Target if I can, just because I don't want it to disappear. That's a simple example consumption-wise, but I think if you could buy a business locally or from a retiree or your kids want to, that's an interesting play. If you look out 25 years, because we might be one where we don't see whatever the next correction is, whether it's bad or minimum, there will be something with this CapEx spend. It just history tells it. Railroads did it, fiber did it, like telecom did. I mean, it's happening. Whether it's 2 years from now or not, who knows? But it's very likely it could be another 15, 20 years before we fully recover. So if you're 50 plus, that means you're not out of it when you're taking your money and trying to retire, right? So
mhm.
you might want to diversify into something that is a little bit more tangible and local with some of that longer term capital. I don't know. I'm not
Yeah,
giving financial advice. I'm just telling you what I think about and that your kind of data maps to. So it was been fascinating. We covered a lot of ground. Matthew, appreciate you being here. Thanks everybody who tuned in live. Subscribe at the link in the chat, or you can just click the button if you're watching this on the video. Subscribe to Matt. Please do him a favor by thanking him. Get him over 55,000. That'd be awesome. It's a nice round number for the end of the year. And we'll have to have you back. I'd love to stay in touch and kind of comment on a bunch of the posts that you have coming out. And thanks for being on the Atomic Level. You work remotely. For those who hire people remotely, one of our Wealth Commander Pro subscribers is Pebble. You've heard me talk about him before. I use him personally. I could hire a guy like Matt and not put my nexus in California, but have a great guy in San Francisco working through an employer of record. And if you're looking for those kind of structures and tax strategies, they're a great resource. I use them personally. HighPebble.ai. Check them out. So that is it, buddy. That's the show. You did a hell of a job. Any final words for the group before we let them go?
well, thanks very much, Chris. I appreciate the time we had together.
Yeah, I appreciate you reaching out back off the DM I sent you and being willing to show up. My audience is always grateful, and they're going to show you that because we're going to all subscribe. So everybody, go do that now. Thanks for
Awesome.
being here, everybody, and we'll see you next time.
Great. Thanks, Chris.